Well, let's welcome in our market master, Pankaj Tibrewal, founder and CIO at IKIGAI Asset Managers, is with us. Pankaj, great to have you with us here on the program. Thank you very much for your time. At the margin, Pankaj, you've been cautious, right? You've been advocating that maybe the time has come to go a little bit more large cap. Too much concentration in mid caps, small caps and smaller caps, perhaps not a great idea. And now we're finally starting to see the breadth of this move narrowing, the breadth of the rally narrowing, Pankaj. So let's begin there. Your observations.
Good morning, Prashant. Over the last few weeks, we have met a lot of investors through different forums. Though the Nifty is making new highs, but you don't see that happiness on the face of investors because their individual portfolios have not participated in the rally the way Nifty has, gone up. And clearly, there are few observations, Prashant, which clearly is now being proved by the data. So if you look at from June till September now, and this quarter is coming to an end today, what we are seeing is the divergence between index return and median index returns has started to happen. In this quarter, NSE 500 index has given about 8.5% returns, but the median return of the index has been about 5.5%, which means the index heavyweight is leading the index higher, but the breadth of the rally has started to narrow. This brings us to the question, is the return of polarization, which has started to happen. And normally when earnings growth starts to slow down, which we saw in the first quarter and likely in the second quarter as well, we see that polarization happens. It happened in 1819 as well. Still early days, but the question is the return of polarization starting to happen? In the mid-cap 150 index, 25 stocks have given the bulk of 50% return of the index. So clearly, you are seeing the median return trailing the index return, and this is the first sign. The second important observation in the market is that there is a style shift starting to happen. Over the last 3 years, you have seen value, momentum, high beta, and in certain areas, low PE doing extremely well. But over the last 3-4 months, post-elections, you are seeing growth, quality, and low volatility making a very sharp comeback. Please don't ignore this because whenever style regimes changes happen, it leads to realigning of your portfolio. It happened 3 years back. Probably interest rate cut may be the catalyst, but it is looking now that probably there is some change in the style which is starting to happen, and portfolios need to adjust towards that. The third point is that we were in a way beneficiaries of Chinese underperformance. Look at the way the Chinese markets have bounced back over the last 1 month. Now, on a year-to-date basis, Chinese markets are outperforming Indian markets. In 1 month, it made the entire change. And hence, though FI flows were not very strong, but on the margin, it could impact the FI flows as we move ahead. Last but not the least, valuations are one standard deviation above overall market. And in certain pockets, it's crazy. Look at the SME part of the market. It's in a different frenzy altogether. 65 times the index is up over the last 5 years. So I think what I would suggest to most of your viewers and the investors in the market, this is the time to go back to basics of investing. Make sure that the quality of the company you are investing is not compromised, and make sure that the portfolio is resilient enough that whenever there is a drawdown, the portfolio stands tall. So these are the few things which is under your control, which you can do.
And hopefully investors are listening to a lot of that sane advice that we're getting in from market veterans like you, Pankaj. I mean, I think that was really well put. And just to sum it up, basically what you're saying, styles are changing. The market's going back to areas like quality, low volatility. Then there's a resurgence of China, and then we have lofty valuations in India. So it's a potent mix, right? Now, against this backdrop, the IPO market continues to sizzle. We have Swiggy coming up, we have Hyundai coming up, and so many more. So just allow us to play this one bite, Pankaj, before we sort of get back on that question of the IPO market. And this bite comes in from one of the biggest poster IPOs of 2021, Paytm and Mr. Vijay Shekhar Sharma. He was on a panel at an industry event, I think on Friday, where in his candid style, he went on to admit that one of the mistakes that he made in life was selecting the wrong merchant bankers. Let's listen into this and we'll come back to the IPO discussion.
I have a regret now, not in the joining of entrepreneurship. I've been entrepreneur for long enough now. I have a regret of not choosing the correct bankers for IPO. If you choose the correct bankers, जैसे भगवान के मंदिर में जाने के लिए आपको सही पुजारी चाहिए होता है, शायद हमने वो नहीं चूज करे तो उसका choose a right banker, my friends. अभी तो छोटी-छोटी IPO भी इतनी बड़ी हो जाती है. In era and age, it was driver making a crore. In Paytm's case, I know 20 people who made ₹1 billion, 100 crores.
Excellent.
20 people. And many of them cashed out more than 100 crores. I'm a bootstrap entrepreneur who had to do a lot of cash generation by the business. And in that rush, I learned only one thing for ladies and gentlemen in the room. There's nothing called P&L. This profitability, which is a P&L, which is an opinion. The real truth is cash. Everything else is a trash.
Lessons learned in the heydays of the new age company bull market, right? And in hindsight, when you end up being a lot wiser. Anyway, let's get back to the question that I was asking, Pankaj. We are in the kind of market that we're in. We're getting a lot of new issues. Do you think mistakes would be made again? What's the advice that you would give out to investors so they don't have that repeat experience? I mean, not just Paytm. Several companies went through the crunch. Zomato came out triumphant. What is the one thing that you would advise to investors now as we're looking at these multi-billion-dollar issues that will hit the screen very soon?
Surabhi, last year we did a piece on IPOs and I posted it on my Twitter handle sometime last year. And the data was staggering. Last year was one of the biggest years in last 20 years in terms of number of IPOs we saw. But if you look at a last 20-year history and IPO sizes of 50 crores and above, 53% of them underperform Nifty. So in the very short term, IPOs tend to look very good. But over a medium to long term, I think very few IPOs do well. And only 24% of the IPOs since 2002 have become 5-baggers or more. And 51% haven't even doubled post-listing. So clearly the data suggests that you need to be selective on the names which come for the market. And clearly on the SME side, we are seeing frenzy and euphoria. I think many of them will probably not see the value over the next 5 to 10 years. So the real advice would be, don't get carried away by greed. It's clearly visible on the street today. Take a more, saner call right now. Make sure that you do your proper homework before investing. Otherwise, in this kinds of market, the probability of making mistake could be much, much higher. And we need to be careful. And I am saying this again, that at this point of the market, we need to be risk manager rather than fund manager. Make sure that you appropriately price the risk in your portfolio so that you can survive on the pitch for a longer periods of time. For that, if you need to give few overs maiden, let it be. But don't lose the wicket. Otherwise, you won't be able to come back to the match.
Amazing. Well put, Pankaj. But, you'll be looking out for that loose delivery, right? To dispatch it to the into the stands. And there's still some opportunities that are still prevalent in the market, be it from the power space, maybe some of the financiers as well. So give and take everything. You're sounding a little bit cautious, particularly about the broader markets, but you're still stating that there are good themes out there. So list a couple of them because our viewers would like to know where should they be building position with conviction for the next few years.
Good morning, Nigel. On the themes, I think power demand and electricity could be a slightly medium to longer term theme and energy transition. And look at some of the data points. After 15 years, US is starting to see increase in demand for electricity, led by data centers, EVs, and so on and so forth. You will be surprised to know that CY19 to CY22, out of the top 10 air conditioning installation markets, 8 were out of Europe. Who would have thought that Europe will install ACs far more than any other country? And 8 cities out of the top 10 are from Europe because of global warming. So I think there are 4 important points: global warming, data center, which is AI, electric vehicles plus Bitcoins and cryptos, and the constraint on transmission and ESG, which is leading to the entire energy transition and increase in demand for power. I think this could be played through various things, distribution, transmission, or generation, and the ancillaries to that. So I think it's a mega trend. Valuations could be something which is prohibitive right now, but keep a close watch on this trend over the next 5-10 years. The second one is the pharma sector. I think, broadly speaking, I think we have still some visibility on earnings growth there. And I think most companies will deliver earnings growth better than the broader market. And I believe that valuations are not so prohibitive there, whether it be the generic player, whether it be domestic or CDMO. I think pharma sector is looking okay. Financials, I believe, is one space where valuations in our favor, whether it be lending or non-lending. And I think insurance is coming out quite strong, as well as some of the banks and NBFCs. So that's another space where we are positive on. And auto ancillaries, don't forget that space. I think many auto companies are changing their texture, not only from pure auto to industrials. And I think that's a big shift which is happening. Who would, kind of expect that recently the global purchase head of Airbus was in India, finalizing vendors for the next decade or so. So I think a lot of areas like aerospace, defense, they are going through their own challenges of supply chain globally. And I think India is finding flavor. And many auto companies are transiting and pivoting themselves, not only from pure auto, but to industries, industrial areas like aerospace, defense. And these are some of the companies to watch out in the portfolio as well. So these are some of the areas where we think you need probably be a positive on. But I again repeat, it will be a bottom-up stock pickers market. The best of the breadth or the best of the broad-based rally which we saw over the last 3 years may be behind us, and the data is suggesting that. And probably our first quarterly newsletter will be coming soon. We'll be elaborating more on that as we move ahead.
But you gave us 3 or 4 broad themes to look for at least, right? I mean, it's become tougher, as you said. Power, pharma, financials, and auto ancs. These are 4 broad areas. And I like what you said. Be a risk manager rather than a fund manager now. I mean, you're in that phase of the market. So I think that's our headline from this one. Pankaj, I know you don't want to talk about single stocks, but just your thought process as an investor. You heard the news flow around. The case is this: PB Fintech. We had the management with us earlier today. Platform company, light asset model, it's done very well. Stock's phenomenal. It's doubled this year. And now it came off about 20% last week on fears that they're going to get into hospitals. Well, they've clarified they're going to do a minority investment up to $100 million one time into an operation which is going to be a network of hospitals. And it's now going to be done in PB Fintech, but an outside company. As an investor, how would you look at this situation? I mean, for those who own it or are thinking about this one.
Prashant, I think rather than commenting on stock specific, I would say that there are few thoughts about the new age companies. When I interact with a lot of them over the last few years, I believe that the private market and public market are 2 different animals. You could take a decision by speaking to 5 people on the private equity side when you are unlisted. But when you are listed, you need to be far more responsible because there are a lot more investors and the thought process is very different. I think we saw that in few cases where at the time of listing, the promoter, the company said, we don't care for profitability. We only care for growth. And over a period of time after listing, market showed that the cash flow is reality and rest everything doesn't matter. And the company came back to profitability and cash flow and see how the market rewarded them over a period of time. This is just one instance where the narrative at the time of IPO and after maybe 18 months of listing was very different and how markets rewarded them. So I think over a period of time, many new age companies, probably who don't have the experience of public market listing, will make those mistakes. But I think companies who kind of correct those mistakes also very fast will kind of move ahead with much, much better market capitalization. So I think it's a learning process. I'm nobody to comment whether the company you mentioned is taking right decision or wrong decision. Its time will suggest. But one should stick to the core. If it's an asset-light model over a period of time, one should strengthen the moat on that. and not pivot too much from their core. I would suggest that. And public markets are a very different animal than the private credit markets.
All right, Pankaj, thank you so much for joining in. And it's really important to get that voice of reason, slight bit of caution as well, perhaps keep it on the table, given the kind of market and the global environment that we're in. Great speaking with you today. Thank you very much for joining in.